Here are more refined and lesser discussed investment insights derived from great investors. 1. Control your emotions. Emotional discipline is more critical than intelligence in investing. Benjamin Graham. 2. Time arbitrage. Take advantage of others' short-term focus by investing with a long-term horizon. Pat Dorsey. 3. Look for asymmetry. Seek investments with limited downside and significant upside potential. Mark Andreessen. 4. Avoid overreaction to headlines. Separate sensational news from actual financial impacts. Ken Fisher. 5. Understand market mechanics. Study how liquidity, flows, and institutional behavior affect prices. Stanley Druckenmiller. 6. Don't chase high-yield investments. Blindly high dividends or yields may indicate underlying risk. Seth Klarman. 7. Focus on capital preservation. The first rule is not to lose money. The second is to remember the first rule. Warren Buffett. 8. Invest in disruption. Early identify transformative trends and enter before they're mainstream. Cathie Wood. 9. Be ready to pivot. If your investment thesis proves wrong, exit without hesitation. Paul Tudor Jones. 10. Understand cycles of innovation. Study how technological waves create new opportunities while disrupting others. Peter Thiel. 11. Avoid overconfidence. Always consider the possibility that you could be wrong. Daniel Kahneman. 12. Behavioral bias. Awareness. Learn about cognitive biases like anchoring, confirmation bias, and loss aversion to avoid common pitfalls. Richard Thaler. 13. Focus on total return. Combine income, dividends, interest, with capital appreciation for a complete view of performance. John Bogle. 14. Invest in real assets. During inflation, real estate, commodities, and inflation-protected securities protect against rising prices. Ray Dalio. 15. Leverage market panic. Market crashes often present once-in-a-lifetime buying opportunities. John Templeton. 16. Be an information synthesizer. Combine insights from various sources for a unique perspective. George Soros. 17. Know the catalysts. Understand what events will drive a stock's price in the short term and the long term. David Einhorn. 18. Be wary of over-optimism in growth stocks. Overpriced growth stocks can lead to significant losses if expectations aren't met. Bill Gross. 19. Focus on tax efficiency. Minimize tax liabilities through long-term holding and tax-advantaged accounts. John Bogle. 20. Recognize the power of network effects. Businesses with strong network effects become exponentially more valuable over time. Reid Hoffman. 21. Consolidation opportunities. Look for industries where consolidation can drive profitability, such as airlines or telecom. Wilbur Ross. 22. Prepare for mean reversion. What goes up excessively often comes down. Anticipate reversion to the mean. Jeremy Grantham. 23. Use quantitative metrics as tools, not crutches. Metrics like PE and PB are useful but should be part of a broader analysis. Robert Schiller. 24. Invest in brands that withstand time. Companies with strong brand loyalty tend to perform well during economic downturns. Pat Dorsey. 25. The 1% rule. Even a 1% improvement in decision-making consistently compounds into massive gains over time. Charlie Munger. These principles provide a nuanced toolkit for building a resilient and effective investment strategy.